trading the markets with clarity, not guesswork. Welcome back to FX Chart Analysis, where we cut through the noise for the serious trader. Music stops. Visual, dynamic, clean chart graphics behind host. Hook, opening lines. Okay, let's be real. You've been trading long enough to know that 90% of the candlestick pattern content out there is recycled nursery rhymes for beginners. Hammer means buy, shooting star means sell. And then you get stopped out wondering what went wrong. The truth is, most traders are using these patterns completely wrong, trapped in a cycle of confirmation bias and false signals. Today, we stop the confusion. We're not just learning patterns. We're learning the context that makes them actually profitable. Main script, 2-minute educational core. Forget memorizing shapes. Professional trading isn't about spotting 3 white soldiers and blindly going long. The critical failure point for most traders is isolating the pattern from its environment. A bullish engulfing pattern at the peak of an overextended rally isn't a buy signal. It's a potential trap exhaustion in disguise. The same pattern, however, emerging at a major historical support level, confluence with a 61.8% Fibonacci retracement, and with momentum divergences on the higher time frame. Now you have a trade with an edge. Context is your first filter. Your second filter is market structure. Are you in a clear trend, or is price chopping through a range? A doji in a strong downtrend is more likely a continuation pause than a reversal sign. A series of indecision candles after a breakout. That's telling you about potential failure or consolidation, not giving you a direct entry. The third pillar is volume and order flow confirmation, though we'll deep dive into that in a future video. Think of each candlestick pattern not as a standalone signal, but as a sentence within the broader paragraph of price action. The pin bar, the inside bar, the fakie setup, they only gain their true meaning from the narrative of the chart, the key levels they form at, the trend they're interrupting, and the liquidity they're likely targeting. Stop looking for the perfect candle and start diagnosing what that candle's formation reveals about the battle between bulls and bears at that precise moment. Are the buyers absorbing supply? Is momentum stalling? That's the real information. Integrate this. Map your significant horizontal levels. Understand the higher time frame trend direction, and then, only then, let a high probability candlestick pattern give you your precise entry and stop loss level. This shifts your analysis from pattern recognition gambling to context-based probability trading. Outro. If this refrain clicked for you, then you're ready for the next level. Smash that like button and subscribe if you haven't. We build on these concepts weekly. In the comments, I want you to post one example. Describe a recent trade where a pattern failed you, and let's dissect the missing context. The most insightful comment gets a shout-out in next week's video. For our premium community, the deep dive webinar this Thursday will break down advanced order flow tactics to pair with these patterns. Link in the description. Until then, trade the structure, not just the candle. This is FX Chart Analysis. I'll see you on the charts.